When you drive across a bridge, visit a school, or turn on a street light, chances are part of that infrastructure was financed through a municipal bond. Municipal bonds, often called Munis, are debt securities issued by states, cities, counties, and local agencies to fund public projects. They're the essential borrowing mechanism of local government, allowing communities to raise money for construction, expansion, and renewal without raising taxes immediately. For investors, municipal bonds are unique because of one key feature. The interest they pay is typically exempt from federal income tax. And if the investor lives in the state where the bond music fades in, calm brass and quiet strings, steady rhythm suggesting city life and infrastructure. When you drive across a bridge, visit a school, or turn on a streetlight, chances are part of that infrastructure was financed through a municipal bond. Municipal bonds, often called munis, are debt securities issued by states, cities, counties, and local agencies to fund public projects. They're the essential borrowing mechanism of local government, allowing communities to raise money for construction, expansion, and renewal without raising taxes immediately. For investors, municipal bonds are unique because of one key feature. The interest they pay is typically exempt from federal income tax. And if the investor lives in the state where the bond is issued, that interest may also be exempt from state and local tax. This triple tax exemption can make Munis especially attractive to high-income investors in high-tax states. There are two primary categories of municipal bonds: general obligation bonds and revenue bonds. General obligation, or GO bonds, are backed by the full faith, credit, and taxing power of the issuing municipality. They're considered the safest type of muni because repayment comes from taxes, not from the revenue of a specific project. Go bonds often require voter approval before issuance since they represent a commitment of taxpayer resources. States can pledge income and sales taxes to back their GOs. Cities and counties typically rely on property taxes. The exam often describes the difference this way. If the issuer defaults, taxpayers are ultimately responsible. That's the defining characteristic of a GO bond. Revenue bonds, on the other hand, are repaid solely from the income generated by the project they finance. Think toll bridges, hospitals, airports, or water systems, anything that produces user fees. Because they're not backed by taxes, revenue bonds carry more risk than GOs, but also offer higher yields. The issuer is not legally obligated to support the bonds beyond the project's revenues. Revenue bonds often include a trust indenture, a formal agreement between the issuer and a trustee, typically a bank, that defines the rights of bondholders and outlines protective covenants. These covenants spell out how the issuer must manage revenues, maintain the project, and preserve its ability to pay investors. You'll see several variations of revenue bonds on the exam. Industrial Development Revenue Bonds, or IDRs, are issued by a municipality on behalf of a private company to finance construction or expansion of a facility. The bonds are backed by lease payments from the company, not by taxes or general revenues. Because the proceeds benefit a private entity, the interest may be subject to the Alternative Minimum Tax, or AMT. Lease rental bonds finance facilities leased to government agencies. For example, a county issuing bonds to build a courthouse that's leased to the state. The lease payments are the source of revenue. Special tax bonds are backed by taxes other than property taxes. For example, excise taxes on gasoline, tobacco, or alcohol. Special assessment bonds are repaid from charges on the properties that benefit from the improvement, like new sidewalks or sewer systems. There are also moral obligation bonds, which are revenue bonds with an added layer of security. If revenues aren't sufficient, the state legislature may choose, though not be required, to appropriate funds to pay debt service. The moral in moral obligation refers to political rather than legal responsibility. Double-barreled bonds have both revenue and tax backing. If the project's revenue is insufficient, the issuer pledges its taxing power as a secondary source of payment. Because of that backing, these are treated as go bonds for credit purposes. You may also see certificates of participation, or CHOPs, which represent a share in lease payments made by a government entity. They allow municipalities to raise funds without issuing traditional long-term debt and without technically creating a debt obligation that requires voter approval. Municipalities can also issue variable rate demand obligations, or VRDOs. These long-term securities have interest rates that reset periodically, often weekly, based on current market conditions. Investors can put the bond back to the issuer at par on reset dates, which gives them short-term liquidity, while the issuer benefits from long-term financing. Another short-term financing tool is the municipal note. Notes are used to manage cash flow and are repaid with the proceeds from future revenues or bond issues. Examples include tax anticipation notes, repaid with future tax receipts; revenue anticipation notes, RANs, repaid with future revenues from projects or federal grants; bond anticipation notes, BANs, repaid with proceeds from a future bond issue; tax and revenue anticipation notes, RANs, backed by a combination of both. All municipal notes are short-term and are considered money market instruments. For exam purposes, it's important to understand how muni interest is taxed, or rather, how it isn't. Municipal bond interest is exempt from federal tax. If you buy bonds issued by your home state or one of its subdivisions, the interest is also exempt from state and local tax. However, if you buy an out-of-state muni, your home state may tax the interest. And if you buy certain private activity bonds, like industrial development bonds, their interest might be subject to the alternative minimum tax. Capital gains from the sale of muni bonds are always taxable at the federal level because they represent profit from trading, not from interest income. Municipal bonds are typically quoted on a yield basis, meaning the quote represents the yield to maturity or yield to call, rather than a price. Because many munis are callable, the lower of the two, yield to call or yield to maturity, must be shown to investors. This is known as the yield to worst rule. The secondary market for municipal bonds operates over the counter among broker-dealers and institutional investors. Municipal bonds are not marginable when issued, but they may become marginable after being held for 30 days. When you hear the phrase "the bond buyer," remember that it's the daily publication that tracks the municipal market. It provides information such as the visible supply, which measures the total dollar amount of new municipal bonds expected to reach the market within the next 30 days. It reflects the supply side of the market. The placement ratio, which measures the percentage of new issues sold by underwriting syndicates during the week, a measure of demand. The 20 bond index, which shows the average yield on 20 general obligation bonds with 20-year maturities and ratings of AA by S&P and AI2 by Moody's. The 11 bond index, made up of 11 of those 20 bonds with higher average ratings of AA plus by S&P and AI1 by Moody's. The revenue bond index, which tracks 25 revenue bonds with 30-year maturities rated A plus by S&P and A1 by Moody's. Together, these indexes show trends in the municipal bond market, helping analysts gauge interest rate direction and relative yields. When comparing municipal bonds to other fixed income securities, investors use the tax equivalent yield formula to see how a tax-free yield compares to a taxable one. The formula is tax-free yield divided by 1 minus the investor's tax rate equals the taxable equivalent yield. For example, a 4% muni yield for someone in the 25% tax bracket is equivalent to a taxable yield of roughly 5.33%. Risk in the municipal market is primarily credit risk, the chance that the issuer will fail to make payments, and market risk, the risk that interest rates will rise and the value of existing bonds will fall. Some municipal bonds are insured by companies such as MBIA or Assured Guarantee, which guarantees timely payment of principal and interest, further reducing risk. For investors seeking predictable income and safety of principal with the added benefit of tax exemption, municipal bonds remain an essential instrument. And for cities, counties, and states, they're the lifeblood of public finance, the quiet, ongoing partnership between government and the investing public that builds the world around us. For the Series 7, remember these keys. General obligation bonds are backed by taxes. Revenue bonds are backed by project income. And for every municipal question, think about what's backing the promise: taxes, fees, or moral obligation, and how that affects both yield and suitability. Because in the end, understanding municipal bonds means understanding how communities fund the future and how investors make that future possible.